You have probably noticed that something feels off, not dramatically off, not in a way that makes headlines every day, but in a quiet, grinding way that shows up every time you buy groceries, fill up your car, book a flight, or look at your bank account and wonder why the number never seems to grow the way it should. What you are feeling is not your imagination, and it is not just inflation in the traditional sense. Something bigger is happening underneath the surface, and if you do not understand it, it will cost you, quietly, consistently, for years. The dollar is weakening, not collapsing, not disappearing, but losing ground in ways that directly affect your purchasing power, your savings, your investments, and your financial future. And almost nobody is explaining what that actually means for a regular person trying to build wealth. That is what this video is for. The dollar does not exist in isolation. It exists in relationship to everything else: other currencies, commodities, goods, services, and assets. When people say the dollar is weakening, they mean one specific thing. Each dollar you hold is buying less than it used to. Less of a product, less of a service, less of another currency, less of the future you were planning for. This happens for several reasons. When the government prints more money, which the US has done significantly over the past several years, there are more dollars chasing the same amount of goods. More supply of dollars means each individual dollar is worth slightly less. This is the most basic form of currency devaluation. It also happens when other countries lose confidence in the dollar as the dominant global reserve currency. For decades, the US dollar has been the currency the world uses to trade oil, commodities, and major assets. That status gave the dollar extraordinary strength, but that status is being quietly challenged right now in ways that matter, and it happens when interest rates shift. When the Federal Reserve raises rates, the dollar tends to strengthen because higher rates attract foreign investment. When rates come down, or when the market expects them to, the dollar tends to weaken. Right now, several of these forces are happening simultaneously, and the effect on your everyday financial life is real, whether you can see it or not. What a weaker dollar does to your savings. This is the part nobody talks about directly, and it is the most important part for anyone who is trying to build financial security. If the dollar weakens by 5% over the next year, and your savings account is earning 2% interest, you did not gain 2%. You lost 3% in real terms, in purchasing power, in what that money can actually buy. Your balance went up, your wealth went down. That is the quiet theft that a weakening dollar performs on people who are doing everything right, saving consistently, being responsible, building a cushion, but keeping their money in places that do not keep up. A standard savings account at a traditional bank earning 0.5% or less is not a safe place to park money during a period of dollar weakness. It feels safe because the number does not go down, but the number is lying to you. The purchasing power behind that number is shrinking every single month. This is why the conversation about high-yield savings accounts matters so much right now. Not because they are exciting, because a 4% or 5% return on cash at least partially offsets what a weakening dollar is quietly taking from you. It does not fully solve the problem, but it slows the bleeding significantly. And for anyone who is keeping significant cash in a checking account, just sitting there, available, earning nothing, a weakening dollar is an invisible tax being collected on that money every single day. You have felt this already. You just might not have connected it to the dollar specifically. When the dollar weakens, imports become more expensive. The United States imports an enormous amount of what its people consume: electronics, clothing, cars, food, raw materials. When those goods are priced in other currencies and the dollar buys less of those currencies, the price of those goods goes up. That is why your grocery bill feels disconnected from your salary. That is why a phone that cost $800 3 years ago costs $1,100 today. That is why the price of things that used to feel stable now feels like it resets upward every few months. This is not just inflation in the abstract. This is the dollar losing its ability to protect your standard of living. And the people who feel it most are the people who are spending most of their income, which is most people. The practical consequence is this: if your income is not growing at least as fast as the dollar is weakening, your real standard of living is declining. Even if the number on your paycheck stays the same, even if you feel like you are doing fine, you are running on a treadmill that is quietly speeding up. And most people do not realize it until they are already out of breath. Here is the one place where a weaker dollar actually works in your favor: if you have fixed rate debt. When you owe $20,000 on a car loan at a fixed interest rate, that $20,000 does not change. But if the dollar weakens over the next few years, the real value of that $20,000 shrinks. You are repaying the loan with dollars that are worth slightly less than the dollars you borrowed. This is why real estate investors and people with long-term fixed-rate mortgages often benefit during periods of dollar weakness. The debt stays fixed. The asset, the house, tends to increase in value as the dollar weakens because real assets hold purchasing power better than cash. This is also why high-interest variable rate debt is so dangerous right now. If your credit card rate can adjust upward, or if you have a variable rate loan of any kind, a weakening dollar environment combined with interest rate volatility can make that debt significantly more expensive very quickly. The lesson here is straightforward. Fixed-rate debt during dollar weakness is manageable. Variable rate debt during dollar weakness is a trap that can tighten around you faster than you expect. If you have money in the stock market, even through a 401k or IRA that you do not pay much attention to, a weakening dollar affects you in ways that are both helpful and harmful depending on what you own. U.S. companies that do significant business internationally actually tend to benefit from a weaker dollar. When a U.S. company earns revenue in euros or yen or other currencies and converts those earnings back to dollars, a weaker dollar means those foreign earnings are worth more in dollar terms. This is why multinational companies, the kind that make up much of the S&P 500, often perform reasonably well during periods of dollar weakness. But companies that rely heavily on imports, that buy raw materials or finished goods from overseas, see their costs go up as the dollar weakens. Their margins compress, their profits shrink, and that shows up in their stock price. For someone with a diversified index fund, these effects partially offset each other, which is one of many reasons why broad diversification matters more during periods of currency uncertainty than during stable periods. But there is a more important point here for anyone who is keeping all of their financial eggs in dollar-denominated baskets. When the dollar weakens, assets that are priced independently of the dollar tend to hold or increase their value. Real estate, commodities, international stocks, certain alternative assets. These are not recommendations. They are observations about how money moves during periods of currency pressure. The people who protect their wealth during dollar weakness are the people who have spread their assets across things that do not all move in the same direction at the same time. Here is the part of this conversation that most financial content skips entirely. Dollar weakness is not new. It is not a crisis. It is a slow, recurring feature of how fiat currencies work over time. The dollar has lost more than 95% of its purchasing power since 1913. That sounds alarming, until you realize it happened gradually over more than a century, and that during that same period, people who owned assets rather than just held cash built extraordinary wealth. The dollar weakening is not the threat. The threat is holding your financial life in a form that does not keep up. Cash that earns nothing loses. Cash in a high-yield account loses more slowly. Assets that grow with the economy, businesses, real estate, broad market investments, tend to preserve and grow purchasing power over time, even as the currency itself weakens. This is not about predicting the future. It is about understanding what money actually is. Money is not wealth. Money is a tool for storing and exchanging value. When the tool itself becomes less reliable, the people who understand this move more of their value into things that hold it better. The people who keep all of their value in the tool, in cash, in a checking account, in a savings account that barely beats zero, are the people who feel the dollar weakening most painfully, because they have nothing else working for them. You do not need to panic. You do not need to make dramatic moves. You need to make intentional ones. Step 1. Stop letting cash sit idle. Any money that is sitting in a checking account or low-yield savings account right now is losing value in real terms. Move it to a high-yield savings account earning at least 4%. This is not investing. This is not risky. This is the minimum responsible action during a period of dollar pressure. Step 2. Review your debt structure. If you have variable rate debt, understand what happens to your payments if rates shift. If you have high-interest credit card debt, that is your most urgent financial problem right now. A weakening dollar combined with high-interest debt is one of the most effective wealth-destroying combinations that exists. Step 3. Make sure your investments are actually diversified. If everything you own is dollar-denominated and U.S.-focused, you have concentration risk. A broad market index fund that includes international exposure is a simple, low-cost way to spread that risk without making complex bets on specific markets or assets. Step 4. Think about your income. A salary that does not grow is a salary that shrinks in real terms during dollar weakness. This is the moment to think seriously about skills, negotiation, side income, or any path to increasing what comes in. Because the expenses are going up, whether the income does or not. Step 5. Do not make fear-based decisions. The worst financial moves people make during periods of economic uncertainty are reactive ones. Pulling money out of the market at the wrong time. Moving everything into cash right when cash is losing value. Making dramatic changes based on headlines rather than strategy. Stay invested. Stay diversified. Stay consistent. And make sure the structure you have is working for you, not just sitting there while the dollar quietly does its work. The dollar weakening is not something that happens to other people in other countries. It is happening to your grocery bill, your rent, your savings, your future. And the difference between the people who come out of this period ahead and the people who fall further behind is not luck. It is not income. It is not some special knowledge that only financial professionals have access to. It is whether your money is working or just sitting. A weakening dollar punishes passive money. It rewards money that is moving into assets, into growth, into things that hold value as the currency shifts beneath them. You now understand what is happening. You understand why it is happening, and you have a clear picture of what to do about it. The next step is yours. Anna Investment is here every step of the way.